In this video, we're going to be talking about understanding stocks and cryptocurrencies. We're going to be going over the definition of stocks and cryptocurrencies, the places you can trade both of these assets, and how to diversify your portfolio. So first off, what are stocks? Stocks are shares of companies, and you may ask, why would a company just randomly give out ownership of their company to random people? Well, this is so they could raise money, and also there's many market participants, so these are more minuscule amounts of their company that they're offering. Stocks are available on many exchanges through fractional shares, which means if a stock is $500, you don't have to buy that one share for $500. You can buy a tenth of that share for much less, and so on, which we're going to be talking about later on when we go over the exchanges. When companies announce good plans, report good earnings, show high demand from the market, show longevity in their operations, and have bullish technical signals, their prices raise. When companies are losing money, have bad press, show bearish technical signals, their prices lower. Now, stocks, especially in America, are traded to the public once they have their initial public offering, known as an IPO. And most of them are traded on the New York Stock Exchange. NYSE is its abbreviation. Now, this is something that you should be aware of if you're new to all of this. Certain market conditions like the Great Recession, the Great Depression, the 2008 real estate bubble, COVID-19 this year, they all create high volatility as people are uncertain about the economic situation in the country. So during these times, you really have to adapt how you're trading. You need to definitely be a lot safer with what you're investing in and how much money you're putting in. So you just have to, take more precaution during these times. Now, cryptocurrencies are pretty confusing, especially to beginners. The most basic way to describe a cryptocurrency is that it's a digital project and it's based on cryptography, which is basically mathematical functions that provide security and consistency. Now, a big factor as to why cryptocurrency has done so well lately is decentralization. This pretty much means that it's taking away the middleman, taking away the control that a government or a bank could have over your money. And there still is taxes and fees and stuff like that, but cryptocurrencies, the prices and how they're traded, even though they are in exchanges, is pretty much, transaction based. Some users for crypto are secure transactions, like I just said, the ability to remove a middleman, and the fact that it's liquid money that is not physical. Except, basically, especially recently, a lot of new cryptocurrency projects have seen really bad crashes as, it's becoming a lot more easier to just say, hey, I have this cryptocurrency, and people try to promote it and stuff. So you really have to be careful about what you're getting into to try and prevent yourself from getting into a scam or any risk. I mean, there was a big Twitter thing a couple weeks ago where people were telling you to send money to an address and you're going to get like double money back. Those are all genuinely scams. So stay away from stuff like that, because once you send crypto to another wallet, it's not coming back. Moving on to help you understand crypto and how it pretty much works. Crypto is built on blockchains, which are basically these public records of data that have transactions and the info from these transactions. This can't really be controlled. Whenever a transaction takes place, it pops up publicly for anybody to see. It's not going to say your name, but it'll say your wallet address, which we're going to talk about in a second. Another thing about crypto is mining. You might hear of a lot of people that mine Bitcoin and things like that. And this pretty much means that they have computers that are typically very high end, and they solve these really tough mathematical problems. Somewhere I saw it was like a 1 in 13 trillion chance of solving it, but basically these help to verify the transactions to prevent people from trying to inflate prices and just manipulate their transactions. Currently, several cryptos can be bought on a variety of exchanges. The amount of coins you can get really depends on your location, but generally speaking, coins with higher market cap, which is just a little explanation for market cap, that's the number of shares that a company is giving available to the public, and then you multiply that by the share price. So that's just a little thing to help verify how big a project is. So, most of these with higher market caps are available pretty much everywhere. Now, crypto wallets or addresses are basically where your money is kept if you own crypto. They're pretty much very long, unique codes that you can send money to other wallets with their codes, and you can have you can see what's in your wallet, and all of this will be taking place through the blockchain. The fees and processing time, if you are transacting crypto with somebody else, depends on what coin you're transacting, so also keep that in mind. Moving on, there's plenty of places to trade stocks. Each one has different fees, and some offer fractional shares, some don't. Some have retirement options. There's a lot of things that you need to be looking into. But some popular places you can trade are Fidelity, TD Ameritrade, Charles Schwab, bank accounts that offer trading access, such as a Chase bank account, Webull, Robinhood, E-Trade, and Vanguard. If you want to trade cryptocurrency, you can trade on Binance, Coinbase Pro. Just a tip for some new beginners, don't get the normal Coinbase because the fees are much higher. Kraken, Bitfinex, Bitrex, Gemini, and KuCoin. Now the final part of this video is diversification. We're mainly going to be talking about stocks and crypto throughout this course, but you can trade anything that changes in price, like gold, silver, currencies, agricultural products, and even art. Not that it's really on charts and stuff, but prices do change with art. Basically, you want to be putting yourself in a position where if one of the markets you're in crashes, you're not going to lose all your money or everything that you are currently investing. You want to have multiple options to make profits and prevent yourself from losing a lot of money very fast. A good way, especially for stocks, to do this is through indexes, even though they are less volatile, which means their prices move less over short periods of time. Overall, most indexes that are well known go up over time as the economy gets better and stronger. So what these indexes are basically a combination of multiple stocks, such as the S&P 500, which contains 500 highly rated stocks. And it takes all of their prices together and averages out the percentage of their change. So this is a way to be really, really heavily diversified. And then finally, it's just a little quote. You got to find what you like best. Make sure not to put all your eggs in one basket, which is a quote from Warren Buffett, I think. But yeah, regardless, give yourself more opportunities and less risk. Trade safely, and let's get into the technical analysis and video number 3. If you haven't already, make sure to like, comment, and subscribe.